Hello and welcome. I am Raj from EPK Capital. For over 2 decades, I have helped people just like you navigate the financial markets to secure their financial futures. Today, we are going to talk about a topic that often makes investors nervous but holds incredible potential: emerging markets. When people hear about investing in places like India, Brazil, or Southeast Asia, they often picture extreme volatility and unpredictable outcomes. They think it is too dangerous for their hard earned money. But what if I told you there is a way to capture explosive growth? At EPK Capital, we believe that building wealth for generations requires looking beyond your own borders. So grab a cup of coffee and let us dive into how you can safely invest in emerging markets. First, let us look at why these markets are so appealing in the first place. Think about the countries you live in: the United States, the UK, or Western Europe. These are developed economies, they are stable, but their growth is relatively slow because they are already fully built out. Emerging markets are different. They are the engines of global growth right now. Countries like India have massive young populations. Their middle class is expanding at a breathtaking pace. Millions of people are buying their first cars, upgrading their smartphones, and using financial services for the very first time. This creates a massive wave of consumer spending and corporate growth that simply cannot be matched in older, developed nations. As an investor, you want your money to be where the growth is. But that brings us to the elephant in the room: the myth of high risk. It is natural to feel hesitant. Emerging markets have a reputation for being bumpy, with sudden policy changes or inflation spikes. If you are looking to make a quick profit in 6 months, yes, emerging markets are highly risky. But investing is not a sprint, it is a marathon. The volatility you see over a few months or even a year starts to flatten out when you stretch your timeline to 10, 15, or 20 years. Time is your greatest shock absorber. When you extend your time horizon and use the right strategies, you neutralize the short term noise and align yourself with the long term upward trajectory of these growing economies. You do not have to accept wild swings in your portfolio to participate in this growth. So, how do we actually do this safely? Rule number one is to avoid the temptation of picking individual stocks. Imagine trying to find the single best technology startup in a country halfway across the world where you do not speak the language or understand the local business culture. It is incredibly dangerous. If that one company fails, your entire investment is gone. Instead, we use the power of broad-based funds. Think of exchange-traded funds or mutual funds as a giant basket. When you buy into one of these funds, you are buying tiny pieces of hundreds of different companies across multiple countries. If one bank in Brazil or one tech company in Taiwan has a bad quarter, it is a tiny drop in the bucket. The success of the other hundreds of companies holds your investment up. This approach instantly diversifies your risk and gives you a safe, stable entry point into the global growth story. Now, as a bonus, I have created an in-depth guide to the 7 costly tax traps for high net worth NRIs, a strategic report on avoidance and compliance. You can download it simply by clicking on the link in the description. Let's continue now. Let me share one of my favorite strategies from my 20 years in wealth management. It is called the picks and shovels approach. Back during the famous gold rush, the people who made the most consistent wealth were not the miners digging for gold. It was the merchants selling the picks, the shovels, and the blue jeans. We can apply this exact same logic to emerging markets today. You do not necessarily have to buy companies located in India or South America to benefit from their growth. Instead, you can buy shares of massive, stable companies headquartered in the United States or Europe that make a huge portion of their money selling to emerging markets. Think about major global consumer brands, healthcare giants, or technology hardware companies. They rely heavily on the rising middle class in developing nations for their profits. You get the incredible growth exposure, but your money stays wrapped in the strict regulations and stability of the developed world. If you do decide to invest directly into emerging market funds, you must focus on quality. This brings us to our next strategy, focusing on blue chip companies and dividend payers. Blue chips are the massive, dominant companies in a country. Think of the largest telecom provider in India or the biggest utility company in Mexico. These companies are deeply embedded in the daily lives of millions of people. They have strong balance sheets, established operations, and they generate a lot of cash. Because they make so much cash, they often pay regular dividends to their investors. Dividends are incredibly important for reducing risk. When the stock market gets bumpy and share prices drop a little, those regular cash dividend payments act as a cushion for your portfolio. It is like getting paid simply for holding on to the investment, which makes the ride much smoother. There is one technical detail we need to simplify, and that is currency risk. When you invest overseas, your home currency, let us say the US dollar or the British pound, is converted into the local currency, like the Indian rupee. Let us pretend your investments in India perform brilliantly and the stock prices go up. But at the same time, the rupee loses value compared to your dollar. When you convert that money back home, your actual profits will be smaller than you expected because the exchange rate worked against you. That is currency risk in plain English. The good news is that you do not have to be a currency trader to solve this. You can look for specific investment funds that are labeled as currency hedged. A hedged fund essentially locks in the exchange rate for you behind the scenes, removing that layer of unpredictability and protecting your returns. Finally, the ultimate safety net is how you build your overall portfolio. This comes down to smart asset allocation and dollar cost averaging. Emerging markets should never be your entire portfolio. For most investors, it should represent a specific, calculated slice of the pie. Depending on your age and goals, this usually means anywhere from 5 to 15% of your total investments. This gives you enough exposure to boost your overall returns, but not so much that a bad month in global markets will derail your retirement plans. Furthermore, do not invest all your money on the same day. Use a method called dollar cost averaging. This means investing a set amount of money every single month, regardless of what the news says. When the markets are down, your monthly contribution buys more shares on sale. When the markets are up, the shares you already own increase in value. It takes the emotion out of investing and automatically smooths out the bumpy rides over time. Investing in emerging markets does not have to be a gamble. By using broad funds, focusing on quality companies, and managing your exposure, you can participate in the greatest economic growth story of our lifetime with total confidence. Now, I have an action item for you. Take a few minutes this week to look at your current investment or retirement portfolio. Do you know how much exposure you have to emerging markets right now? You might have none at all, missing out on vital growth. Or you might be overexposed in high-risk areas without realizing it. If you look at your portfolio and realize you need a tailored, professional strategy, we are here to help. Reach out to us at EPK Capital for a comprehensive portfolio review. Our team would be delighted to guide you. Remember, at EPK Capital, we build wealth for generations. Thank you so much for watching, and I will see you in the next video.